Good morning, everyone. Thank you for joining, and thank you for listening later if you listen back to the recording. Great to be here to talk about the performance of the trust over the 6 months for our half year. So that's the period from March until September 2024. I'm going to talk about some of the things that happened over that period. I'll talk about performance of the trust, and then portfolio changes we've made to your investments, and a little bit on what the outlook might be for 2025 after that. And then delighted to take any Q&A afterwards, and I'll give all the difficult ones to Paul to answer. If we move forwards, a quick reminder of what the trust does. This is a differentiated strategy to deliver a high level of resilient income for shareholders. So we invest primarily in UK equities with a genuine multi-cap style agnostic approach. And we diversify that by holding some overseas equities, and importantly, by having about 20% of the portfolio in high yielding preference shares, which really allow us to deliver that high yield for end clients, but also gives a bit more flexibility in the equity portfolio as well, and give us that style flexibility that we like to have through cycle. Moving on to some highlights for the half year. So performance overall has been positive. Total return of 6.8% over the 6 months, which was ahead of the benchmark. And hopefully the discount over that period close up as well. So the share price performance plus 14.5% in 6 months is a good return. As Paul said, the discount has come in and out over the period. We can maybe talk a bit more about that later, but share price return over the half year was encouraging. I think more importantly, income generation was also very good. So earnings per share grew 6.5% over the period. And the portfolio continues to deliver that really high level of yield to shareholders with a strong dividend yield as of today, just over 6%. That compares to the UK equity market at about 3.8%. So you've got a really big kind of 60% premium on your income compared to the benchmark. And that's something that is obviously very important to us. And the outlook for income remains, I think, pretty encouraging. Let's go forward. So we'll talk a little bit about the market backdrop and what happened in the 6 months. It was a kind of a period where the market was very focused on political events, both in the UK and overseas. In the UK, we obviously had the election at the start of the period, than expected, and that clear Labour majority that happened. From our point of view in the investment world, that was expected, but we like that big majority. We like to see stable governments with a mandate to get things done, and a high level of visibility for the next 5 years in the UK, which is super useful. As we move forward through the year, we've obviously seen the budget, which is actually seeing the rubber hit the road for some of the policies from that government. And that budget, I think the headline take, to be honest, would be slightly disappointing. You know, we've seen the Labour government come in with a very strong pro-growth message, but the budget and the initial moves probably haven't quite backed that up so far. So the chart you can see there on the bottom left gives the OBR's assessment of what that budget means in simple terms. And the orange dots tell you, yes, there's a positive impact on GDP in the near term, but there's a big shift if you kind of break that down from private consumption and private investment, business investment, into government investment and government consumption instead. And generally, public spending and investment is materially less efficient than letting the private sector do that. So we would probably see that as a slight negative. The hope would be that we do still have some more pro-growth policies to come through as the government seasons a little bit. And the market reaction to that budget, I think people think it was quite negative, but actually it was pretty benign. The chart on the right shows you how gilt yields moved. They did go up on the budget, and how sterling moved. Sterling did go down on the budget. But if you compare that move in the little circle on the right-hand side of the chart compared to the infamous trust budget of September 2022, we are not talking about in any way the same kind of reaction. And if anything, as we've moved forwards into December, those negative sterling and gilt yield moves have actually moderated back slightly. So I think the market has digested UK politics and budget and moved forwards. And the thing that I think that is super important that is often played down is visibility and reliability of policy. And one thing we get from the government and from businesses we talk to is that actually consistency is super important for them. So we would expect to see, even if policies are not the entirely pro-market, pro-growth policies we would like to see, we can rely on them being stable for a period of time. And that's something we haven't really had in the UK. It sets us apart from recent history. It sets us apart from certainly some of our near neighbours at the moment, and it's very useful for business. Next slide, please. The other big event of the period has been the US elections, and we've seen Donald Trump returning to power with a much bigger majority and even a bigger share of the popular vote than I think anyone would have expected. And that creates a change in the investment environment. It's certainly created a change in markets in the last month or so. And although people tend to say Trump is erratic, we don't know what he's going to do, actually, we kind of do know what he's going to do. He's one of those politicians who is very clear about his policies. And if you look back over his first term, he was unusual in actually doing what he said he was going to do, which doesn't always happen. So what he means for the next term is actually pretty clear. And you can expect headline policies, including lower corporation tax, obviously higher tax, rolling back on some of the pro-environmental regulation like pro-EV mandates, and then seeing action on immigration. And then geopolitically, he's likely to look for a resolution to the Ukraine-Russia conflict. And he's also given clear support to Israel in the Middle East. So you can see those big moving parts. How it plays out, we don't know. But the expectation is that we get a lot of bluster, a lot of hyperbole to start, particularly around tariffs. That's how deals get done, and then things move forwards. You can see the expectation for some of the big market measures in the bottom left chart there. Not the easiest to read, but if you were to go down when you have time, the different measures, we would expect Trump's policies to be pro-inflation, to drive higher bond yields, to be surprisingly a bit mixed for US equities, actually. But overall, it is a roughly pro-growth, pro-economic activity, pro-inflation set of policies that he's bringing to the market. The one thing to be aware of, I think, is that the US deficit, in common with a lot of developed markets, continues to widen. And if you look at projections under Trump policies, that deficit continues to widen to really quite scary levels over the next 10 years. So there is a limitation on what any politician can do in this economic environment, and it's something to watch as we move forwards. Next slide, please. In terms of the broader economic backdrop, looking past politics, the last few years have obviously been dominated by direction of travel for interest rates. That has remained absolutely the case. And it continues to, I think, surprise most investors that the market is sensitive, not just to the base rate, but the nuance about the direction of travel for base rates and the second derivative, how quickly they're going down or up. The chart on the top right just shows you what's happened with interest rates globally over the period. We've peaked up. We've started to see interest rates coming back down, which is obviously useful for business investment. It's useful for us in terms of our fixed income portfolio, and it should help market levels. Direction of travel based on Aberdeen's house view is shown in the dashed line going forwards. We expect that moderation of interest rates to continue. The pace may be slower or faster depending on how the data plays out over the next year, but generally central banks are going to move interest rates lower over time, and we will see that feed through into equity valuations. The thing that's allowing that to happen is obviously that inflation has passed its peak and has come down. The expectation from our side is that inflation continues to moderate back towards a long run average. And indeed, now we're already there, to be fair. Inflation is not high at all at the moment. In the context of the political change that we've talked about, both the UK budget and the Trump policy set are pro-inflation. So just watch the data and you can see the example of the 1970s in the chart on the right there. The current situation has tracked that in a slightly spookily close way. We shouldn't be, I think, completely writing off the potential that we have in a return of inflation as we see these inflationary policies. And if we do get strong economic growth, inflation can come back. The 1970s had some particular issues around commodity prices that caused that second bump, but don't be surprised that inflation is hard to kill and can come back quite quickly. So I wouldn't be surprised if we see it tick up again next year. Next chart. Moving on to market performance over the period, I've just plotted the main developed market performance in the line chart on the left-hand side there. And what you can see is that's been generally a pretty good period for markets. MSCI World up 10% over the 6 months. That is a very strong performance compared to historic averages. And indeed, 2024 overall is now pretty much the best year in recorded history for market performance, which seems surprising given all the things that's happened in the world over that period. If you look at the individual markets, you can see that growth has been really driven by the US again. So the S&P 500 up 14%. And the UK has been around the middle of the pack. It's been better than Europe, worse than the US. We actually got off to a really good start in April, May with the election results, and then it's been flatter since then. But the UK has been a reasonable performer over that time. The dominant driver of market performance remains US tech. And I think you could show any number of charts that would make this look like a bubble market, which is about to burst. I think there's risks there, but the important chart is the one on the top right there, which shows you price return of the world market, excluding the US. And that's the dark blue line. And it's kind of gone down consistently. So the US has outperformed the rest of the world over an extended time period. What's interesting is actually the earnings power of the US market has also been better. So the world has underperformed the US in the same way as the price. That's the light blue line. So actually, outperformance of US has been genuinely justified by earnings growth from that market. That means it's been supported. It removes one of the main characteristics of a bubble, which is that kind of irrational valuation of the market. But despite that, the US is still very expensive. The chart on the bottom right just shows you where all the main markets sit compared to their historic quartile ranges. US is over on the left. You can see it kind of sitting up the top of the chart there, 23 times PE. Even if we take out big tech, it's 20 times PE. It's well above its quartile range historically. The UK, by contrast, is over to the right-hand side. It is the cheapest market, apart from China. China has its own challenges, I would suggest. UK is a much more investable, developed market, and it looks cheap. I think it's interesting that the US is still materially cheaper than Europe, despite probably a weaker economic outlook for Europe. So the UK, from our point of view, continues to look very well priced for the potential. Next chart. So hopefully that gives you a good backdrop for what happened in the market over the 6 months. We'll now talk about how Shires and how your investment performed over that period. The headline numbers are here. I think the main thing is NAV total return of 6.8% over the 6 month period, beat the index. It is a market where it is quite hard to beat the benchmark at the moment. And I think if we deliver that capital return and at the same time we deliver that material premium of yield, that's a very successful 6 months. The closing of the discount, as I mentioned, has helped the share price performance over 6 months. So that is also good to see. And we'd like to see it close up again for sure. And with a big picture view, the trust continues to deliver, I think, what we promised to clients, which is that high level of income, a significant yield premium to the UK equity benchmark. The income continues to grow, and we continue to deliver resilient capital return at the same time. So trying to tick a lot of boxes, but I think doing a good job over the period. Next chart. If we break that performance down into the different sectors, then you can see what kind of drove portfolio performance over the period. I've included the benchmark sectors in the lighter bars there as well, and the portfolio weights is the dots. The good performance has been pretty broad-based over that period. So things like basic materials, the miners have done pretty well. Our position in Anglo American did particularly well as it went through the bid process with BHP. And then we've also done very well in industrials, particularly the UK construction names have done well. Utilities have been strong performers. And there's been a range of stable, slightly more valuated sectors that have delivered good performance. What hasn't worked in 6 months has been energy. We have quite a high weighting to energy because we like the cash flow metrics, we like the income potential there, and it is a cyclical sector. That 6 months was a tricky period for oil and gas prices. Our energy exposure is more defensive than the market, so we have outperformed the sector in the market, but that sector has been a detractor over the short 6 month period, although it has rallied post the period. Next slide. Just talking through some of the things that did well in the period. You can see a range of names here. I won't go through all of them individually. If I was to kind of characterize them, I would say these are names where we like the quality of the companies, but they probably are towards the slightly more value end of the market. So they're things where we think they have genuine quality, but the market doesn't necessarily describe that valuation to them. So something like Morgan Sindall, which is a fantastic business with a great management team, solid balance sheet, high return on capital, and a very strong track record of beating guidance and delivering for investors. It ticks a lot of quality boxes, but it still trades on about 10 times P, so below the market multiple. Over the period, it did what it has done historically. It delivered good upgrades for the business, and it really benefited from strength in some areas like its fit-out business, and the combination of earnings upgrades, high yield, and some re-rating with the market drove a really good return from that stock over the period. Other things like NatWest, banks trade on low valuations. The market doesn't perceive them as high quality, but a company like NatWest, which has a really strong retail market position and delivers high returns as interest rates come back from an abnormally low level, is actually quite a quality business. And we're seeing that re-rating and upgrades combination come through in that business as well over the period. Other things like Imperial Brands, Enel, SSC, much more low beta, less dependence on the economy, utilities and tobacco, very reliable sources of income and yield, have performed well, delivered upgrades, and they're also companies that are buying back stock as well, and that's helped drive the multiple up over time as well. So those kind of, I think, valuation opportunities with underappreciated quality is what's done really well this period. Next slide. Of course, the things that have not done so well are equally worth our attention. The first thing I would highlight is that if you look at the average weight and return of the bottom 10 versus the top 10, the average weight of the bottom 10 is half the average weight of the top 10, which is good. So the things that we have backed have generally done well. The ones here, it's slightly more idiosyncratic. We've seen some small positions like Doc Martens where the consumer headwind has been quite strong, and we're in a holding period while we wait for new management to try and inflect that business. We see long-term value in it, so we're happy to wait, but no doubt over 6 months it's been tricky. There's some names like Melrose and 4imprint, which had extremely good performance coming into this 6 months and have given that back. Melrose has actually rallied again post the period end. But not reasons for us to be particularly concerned about their long-term health. There's some others like Mercedes, again, performed very well into the start of the period and gave that back. We sold out because we thought the outlook was more negative. Unfortunately, we sold it before recent warnings and the shares have continued to sell off. And then there's some cyclical names, Diversified Energy, which tracks the US gas price, generally has been weak, but has then bounced post-period end again. And Energean, which is exposed to Israeli geopolitics as much as anything else, the share price has reflected that over the period. I think ASML is an interesting one where we bought it near the end of the period. We bought it after it had already gone down a reasonable amount, but we were too early to buy in, and it's been a short-term underperformer. We still see the long-term value, so we think that will play out over time, but it hasn't been great over the 6 months. Next slide. So coming to portfolio changes, what we've been doing in the portfolio, and I'll maybe start by just giving a bit of a recap on what we look for in the portfolio. The North Star for Shires is always how do we deliver this high level of income and grow it over time for shareholders. And it's hard to show it in a chart, but I guess what we want to deliver is this high yield. You can see historic yield if we run back over the last 5 years here. The dark blue line is the yield Shires delivered. It's been 6% there or thereabouts over time. It's been very consistent, and I think it's been a very attractive level of return for investors over that period. Over the last few years, we've seen the things we would think of as comparators, some of them like bonds, gilts. As interest rates have risen, that gap has closed. They've delivered a slightly higher yield. As interest rates start to come down, we think that yield will start to go down on the fixed income side, probably. So our focus is on growing that gap, making sure we deliver that premium yield, and make sure that we deliver that income stably to shareholders through cycle and over time. The premium to UK equities and to world equities remains very strong and consistent. When we buy positions, we are focusing on delivering that. Next slide. The approach when we look at the equities, we're genuinely size agnostic and style agnostic. So the top right chart just shows you market cap of the positions along the x-axis and the forward dividend yield on the y-axis. And the point we're making is really that we find attractive levels of yield all the way across that spread from $100 billion plus companies right the way down to a couple of 100 million companies in the UK. Position sizes are independent of that, and yields are independent of size. So we are looking across the whole market for good ideas. At the moment, we have a preference for mid-cap and value within the UK. We see value as cheap, which sounds like a truism, but it is relatively cheap compared to history at the moment. And we see mid-cap in the UK as cheap as well. So you can see we're getting exposure to those parts of the market. We're underweight large cap growth, which we see as probably pretty well priced and not delivering the income we need. We can get much better growth in the mid cap space. So that's where we're playing at the moment. Next slide. So here's some of the things we added over the 6-month period. I think it is a diverse set of names. You can see when we bought them, you can see the yield at purchase, which is important. And I've included the return since we bought them. I would say that is incredibly unimportant. We don't buy things for a return in a 2 to 3 months period. But I think it's interesting to say what has worked so far, what hasn't, what is hopefully still going to work. And if you move down the names, generally we still like that mid-cap value skew. So names like Kia, good value, very good momentum in UK construction. ME Group, small cap, another one with great earnings momentum moving forwards. And then we're trying to find some selective value opportunities, things like London Metric, where we want property exposure as yields tick back up. There's an opportunity there. Or Reckitt Benckiser, for example, getting into a consumer staples company where there's a valuation opportunity as well. And then some things just diversifying a little bit, like GTT is an example of a company exposed to energy markets, but not exposed to energy commodity prices. So just trying to diversify our energy exposure, make it more defensive, and get a high yield and add the quality business that we want there at a nice yield. You can see the things we've exited at the bottom. Please feel free to ask us any questions about individual stocks we've added or sold over the period, but I won't go into those in detail here. Next slide. I'll just talk about a few of those examples in a bit more detail. And I've tried to think of 2 themes over the period that have driven our purchasing, because these are things that are important, I think, give you a little bit of color about what we're looking for in individual stock positions. The first one was underappreciated quality. I think we talk a lot about quality investment, and sometimes it sounds as though we just want to buy quality companies and we're not valuation aware. And I think it's important to make the point that quality is great, but if quality is priced correctly by the market, then you're not finding the upside, you're not creating a difference to consensus. And indeed, if quality is fully priced, then you're creating risk, because if a company disappoints or deteriorates, then the price can go down quite a lot. And we've seen that in a number of, I think, the textbook quality companies over the last year. So when we look for quality, we're really looking for good quality businesses, but where the market doesn't believe that yet. And Kia is a great example. The UK construction space has been a sector that has been out of favor for many years. The market still remembers examples like Carillion going bankrupt in the last cycle, and probably doesn't give that industry credit for changing contract structures, repairing balance sheets, and setting themselves up for a period of actual investment and growth in a much more resilient way. So Kia is, I think, the textbook example of that. It had a near-death experience 5 or 6 years ago, and since then it's moved to a delevered balance sheet. It started paying a yield again this year, And because of its exposure to construction in the UK and therefore to investment in infrastructure, schools, prisons, areas where the UK really needs to spend money, it's actually got a growth outlook and it's got a really good market position where it can deliver stable, well-protected margins in a contract structure that makes that very predictable. So that should drive a re-rating. And it also drives a very cash generative company that pays a good yield and is buying back stock as well. So a good performer and one we still see as very attractive. Another example of trying to find some underappreciated quality is ME Group. And this is a case of, I think, of going down the market spectrum and trying to find things that the market isn't seeing that clearly. ME Group operates photo booths, which sounds very yesterday's business, and it operates automated laundromats. So these don't, I think, jump off the page as quality businesses, but the photo booth business in Europe has very high barriers to entry. It's high return on capital. It's highly cash generative. It's not a growthy business, but it does a lot of the cash dynamics that we like. The laundromat business is a high growth business because you can roll it out with a high return on capital to new sites. And there's a long runway of potential sites in Europe and Asia where that's delivering growth at the moment. So one where the business doesn't sound that high quality, but actually the return metrics, the cash metrics, the growth potential all do tick those boxes for us in terms of high quality and what we're looking for. Next slide. Then I think we're also trying to be valuation aware. We're trying to take opportunities a little bit and not just be lazy long-term holders in the portfolio, which is a dangerous thing to do. We've always struggled to find exposure in consumer staples where we have sufficient income, sufficient valuation to make the position attractive. Reckitt is an example of one where after a period of relative underperformance and some legal challenges, there was a valuation opportunity, a chance to buy a consumer staples company with a 5% yield, with management fixing the problems, with the legal issues in the price and likely to be resolved. But importantly, underlying a really good set of brands that could deliver sustainable growth. So that's an example of being valuation where buying something at a good price where we expect improvements. And then Bodycote, something we've held over the last few years, but it's a cyclical business. So you've got to always remember that. And during the 6 months, it's interesting. We don't do this a lot necessarily, but we sold it in July. Because we thought there was near-term risks to the industrial cycle and to PMIs in their end markets. That played out. The shares went down. We bought it back 20% lower, and obviously with the yield 20% higher. And then we had a positive update post that event, and the shares have gone up about 15% since we bought it back. So it's not an easy thing to do, but I think it's a nice example of being engaged with our portfolio, not being lazy about our positions. And if we see the price is fair, we will sell. If we think there's an opportunity, we will buy back. And I think that's something we're trying to do going forwards. Moving on to 2025 and the outlook going forwards. I'll talk about this very briefly because I think you could talk endlessly about what might happen next year, and it's not always that easy. I've tried to sum up the very big picture here by giving the Aberdeen house view from our economists and what they see as most likely outcomes for next year. So you've got the big issues, a strong Trump win with control over the House, the Senate, gives you the policies we talked about earlier. So higher tariffs, immigration in decline, but some risks about interference with the Fed, etc., and generally a reflationary policy set. That might drive some inflation, but it also drives probably strong US growth going forwards. Something as simple as tax cuts obviously is positive for earnings growth from US companies next year. Next point, it is inflation. We're going to see inflation risks remain very much on the agenda through next year. The tariff policies from Trump will probably result in some pressure on particularly China. A 60% tariff is really quite high. But it's also going to drive a stimulus response from China because they are not going to sit back and not have that negotiating position. They will stimulate the economy. They will likely devalue their currency through that action, and that has implications for Asian equities, but also for growth in that region. Um, we remain positive on AI as a driver of both efficiencies and economic growth and supporting continued earnings growth from tech stocks over the next period. But we're also trying to be very aware of how concentrated equity positions are in that sector. And we do expect as the year goes through, we'll see greater dispersion and differentiation among stock markets. And then real estate, a little bit outside of equities, but important for us because we do have some real estate positions. We've seen that adjustment in valuation to higher bond yields happen. And we're at a point where we can start to look forwards, try and find attractive real estate positions with good yields, and expect to see probably bond yields move in the right direction to support valuations going forward. Next level. The interest rate environment continues to drive a lot of things. And from our point of view, we're still just getting to that point where the market is re-engaging with fundamentals post that zero rate world that we had when growth, ESG, all kind of outperformed very strongly for an extended period of time. The chart on the top right, I think I've used it in every presentation for the last 6 months, but it's important. You've had a period over the last 10 years where growth has outperformed value. And the market, I think, is very much the mindset that growth is the way to go generally. History tells you that's definitely not the case. Like value outperformed growth over the vast majority of market history if you go back over time. And so while we are not going to suddenly become value investors, we want to be style agnostic. We want to find valuation opportunities, and we want to be open to the potential, I think, that as interest rates normalize from very low levels, that driver of growth outperformance is not quite there anymore. So you've got to be a little bit more nimble, and you've got to be more style agnostic in our view. The bottom chart, I think, just shows you the market concentration that we've talked about. It is at an extreme high level at the moment, the orange line there. And although those stocks have merited that outperformance, we've just got to be, I think, aware of the risk of dispersion and finding other opportunities. That's valuable for us as portfolio managers, but I think it's valuable for end investors and clients as well to make sure that their portfolios are not too concentrated and they are looking for other sources of performance and capital over time as well. Next slide. The UK, I feel this time last year was super easy to come and say the UK looks really attractive because we had very low valuation and we also had potential catalysts from an election and an improvement in the UK market coming ahead of us. It feels a little bit harder this year, but the valuation remains compelling. And the chart on the top right there just shows you UK valuations versus the US on a sectoral basis. So you're removing that kind of sectoral mix impact on the market level. And the UK really is cheap compared to the US on the same sectors. And I would point out that a lot of those sectors, energy, basic resources, financials, consumer staples, a lot of them are international sectors where there is not that reason for that valuation dispersion. So we're still finding, even if market levels are high, super attractive valuation opportunities in the UK market. We like the mid cap. The chart on the bottom left is a reminder that 250 versus 100 performance is very correlated with what happens with bond yields. As bond yields go down, history tells you mid caps outperform. So we are setting ourselves up for that. Again, I think the chart on the bottom right is a great chart. It shows you what's driven performance over the last 2 years in local currency. The US, for example, has been a very good performer on the left-hand side, and it's been driven by earnings growth and re-rating, so the light blue and the dark blue bars, and some dividends. The FTSE 250 over on the far right-hand side has delivered flat performance. It hasn't gone anywhere, so it's been a real laggard. But that has all come due to a de-rating. So the PE multiple has gone down on that market, despite the fact the earnings contribution, so the genuine growth from these businesses on a fundamental basis, has been really good. It's been better than the US market. So that, I think, gives you a real potential setup for UK mid caps to do well next year, and that's how we're positioning. Next slide. The other point I want to make is income is super important. Obviously, we're going to say that because we're targeting income in this fund, but over history, the data would play that out. So over the last 20 years, it might not feel like it, but 67%, so 2/3 of your return in the UK has come from dividends. It's been 60% in Europe. It's been a little bit low in the US, but it's still been about 45%. So income really matters. Over the last couple of years, as we've seen capital growth dominate, it hasn't felt like that. But if we look forwards, then the chart in the bottom left is super interesting. What it would tell you is that the higher your multiple, the lower your forward returns. And that is a truism. If you buy something expensively, it's probably going to make you less money. But the market is not very good at thinking about that on a long-term view. Where we are at the moment in the US with a PE of 26 times would tell you that subsequent 10-year returns, if you believe history, are going to be 0%. So that's a tough message for a lot of investors. Maybe it won't play out like that, but you should be aware that you can't expect the market level to necessarily, from this starting point, deliver your returns for you. And in that situation, a reliable income generation actually becomes much more important. If you are delivering 5% plus income year on year over 10 years, then you are very likely to deliver a positive return. The UK, the other chart's just a reminder that the UK is the best market in the world for income in terms of both dividend and buyback yield. So a great place to try and find that genuine return for investors that is not linked to market levels. Next slide. So that wraps it up. I think the 6 months for Shires has been positive NAV return and continued income growth, which is super important. The outlook from our point of view is that we see real value in the UK. We see genuine, attractively valued companies with fundamental growth coming through. And as much as I can pound the table on the importance of income for end investors at the moment, this is a super great time to diversify portfolios, target that income, and get that benefit.